We'll give everybody just a few more seconds to get logged in. All right. Welcome everyone. My name is Rufus Guidry. I am the Senior Manager for Community and Business Relations for InTouch Credit Union. Welcome to our last webinar of the year in our webinar series that we've had. Today we're going to talk about the 2024 annual updates for next year. And we are always happy to have with us Rian. She is the CEO of Silver, who will be taking care of you guys today and answering all of your questions. We will ask that you guys put your questions in the Q&A. We promise you that we will get to all of them in order as they are asked. And so without further ado, I'm going to introduce Rian. But Rian is the CEO of Silver, which provides, excuse me, members like you with retirement calculators, tools, and education through Retired Simplified. Prior to founding Silver, Rian worked for 17 years at JP Morgan, where she advised individuals and families on investments, credit, and wealth planning. We are excited, as always, to have her here with us today to help you learn about the tax updates and tips and annual updates, I guess you should say, that help you optimize everything for hopefully next year and try to get ahead of the curve. So without further ado, Rian, I'm going to turn it over to you.
All right, Rufus. Well, thank you very much for hosting us today, and for all the InTouch Credit Union members, thank you for joining us. As Rufus mentioned, I'm the CEO of Silver, and our platform, Retirement Simplified, is a free member benefit for InTouch Credit Union members, where you can go to get information about all the topics we're going to discuss today. As we go through today's session, I'm just going to, I guess, warn you a little bit that there's a lot of numbers, and I'm not going to hit on every single one in here, because I realized as I was preparing that it, could come across a bit overwhelming. What I want to make sure you know is that all of this that we're going to go through today is actually in the experience of Retirement Simplified. So all you need to do is hit that QR code, scan it, or go to itcu.silver.com, and you can get the class with all the information. So what I'll try to do today is touch on some of the numbers, but really focus on why some of these numbers matter, so you have that context as you then dive in to understand some of the personal things that make sense for you. As always, we are not tax advisors or financial advisors, and so if there's very specific tax questions that you have, going to encourage you to talk to your accountant for that guidance. And as I mentioned, at Silver, our goal is to really help you navigate this set of big decisions you make leading into retirement and in the early years of retirement. At the heart of what we do is we provide you with a retirement score. The goal of the score is to help you estimate how long your savings will last in retirement. To do that, we factor in things like Medicare, Social Security, how much you think you'll be spending in retirement, and where you want to live. What we do with that retirement score is let you understand how some of the decisions you make about things like when you retire, how they can impact your score. And if you want to make your score last longer, give you some tips on how you can make your money last longer in retirement. Included, in addition to all the tools and calculators in Retirement Simplified, we have a lot of education. These are 3 to 5 minute lessons on topics like Social Security, Medicare, taxes, cost of living. Today's webinar on the annual updates is actually a compendium of one large class, which we call our 2024 annual update class, where we go through all the updates that came from the government over the last couple of months that are going to impact your retirement in 2024. So again, this class you can find in Retirement Simplified, but if there's another topic here like Social Security you want to dive deep on, you can also find that in the platform. All right, so what are we going to cover today? I often talk about the fourth quarter as the Super Bowl for retirement, and that's because starting in late September into early October, the government starts releasing data sets that really impact your retirement. Things like what is Medicare going to cost, helping you understand if you're pre-retirement and you need healthcare, what ACA plans are going to cost. Social Security announces the annual cost of living update. The IRS announces how much you can put in retirement savings accounts, and then they update tax brackets along the way. So just when you thought you had everything mastered, every year the government changes the numbers. And so our goal here at Silver is to get you those numbers every year, make sure you know what they are so that you can make kind of the optimizations that you need for your retirement. So I'm going to go through each of these topics. We'll talk a little bit about like why some of these numbers matter. But again, please don't worry about trying to scramble to write down numbers, because I am warning you, there are a lot. The government likes to make it a little bit complicated for us. The starting point's on Medicare. If it was one thing I wanted for those of you that are not enrolled in Medicare yet to walk away with, is really understand that Medicare is not free. Oftentimes this time of year, when you'll see enrollment for Medicare, you'll see advertisements on the television quoting zero premium plans. And I just want to make sure that everyone knows that zero premium does not equal cost. So when you think about budgeting for retirement, you think about the total cost of healthcare and retirement, I would say it's safest to be budgeting for up to $500 per month in healthcare costs. And that's both premiums, but things like out-of-pocket costs and deductibles. And we'll walk through what some of those numbers are. I would also just flag for you that what that number is will vary based on where you live. So parts of Medicare are priced federally. And so we'll talk about parts A and part B, that no matter where you live in America, you pay the same amount. But as you start looking at prescription drug plans and you look at Medicare Advantage and supplemental plans, those actually are priced based on where you live. And so I think we have some members on the phone today from Texas, some from Michigan, some from Nevada. And what I would just say is that unfortunately, each of those numbers is going to be a little bit different because the plans offered in your market will be a bit different. So let's start with Medicare Part A and Part B. So Part A, you can think about as like your hospital insurance, and Part B is really just general medical insurance. Part A, as long as you have worked for a specified time. Sorry, let me go back there. So Part A, as long as you've worked for a specified amount of time, there is not a premium that's charged for Part A. Part B, last year, the premium was about $165, and this year the premium is about $175. So the premiums are up about 6%, so about $10 on a monthly basis. So you need to be setting aside, an extra $120 for the year when you think about those monthly premiums. The government has also increased the Part B deductible from about $226 to $240. As you think about, again, these are premiums. And so just remember that, outside of premiums, retirees are responsible for things like deductibles and co-insurance. And so we'll talk about that a little bit. So on the deductible side, the Part A deductibles and co-insurance, did increase in 2024. The government, when you think about deductibles for Medicare for Part A, there's a couple different components of it. The first part is that for each hospital stay, there's this deductible that in 2024, you're responsible for the first $1,632. There is a window then where the government actually provides you coverage. And then after 60 days, the government expects you to kind of pay back again. And so what you'll see here is just that the co-insurance for days 61 through 90 have increased, as well as what the co-insurance for what's called a skilled nursing facility. That's often a place you might go if you need rehab after being in the hospital. So I guess the message across the board here is that the premiums have all gone up. And so it's just, again, just being mindful that as you're thinking about maybe reassessing your budget for next year, that you're thinking about putting aside a little bit of extra cash for these items. For those of you that may be classified as a high income earner, I did want to flag that there's also this concept called IRMA, which is a surcharge that is applied for both Part B and Part D. If you're a single individual, the IRMA surcharge starts if you're earning more than $103,000 a year. And if you're a married couple, the surcharge hits if you're earning more than $206,000 a year. Just to kind of put it in context, it may be that you're retired and you don't have a lot of income, but you still could be subject to IRMA. And I would just say that some of the things that can trigger IRMA are things like IRA distributions. So if you are receiving, you're distributing your required minimum distributions, if those add up maybe on top of your Social Security so that your income is greater than 103,000. The sale of a home, if it's above your exclusion amount, that can be treated as income from a surcharge perspective. And for those of you that are considering doing Roth conversions, that conversion from a 401k or an IRA into a Roth, any of the gains in that account are deemed to be income. And so that also could trigger the IRMA surcharge. So just kind of flagging that as that, we talked about the baseline prices, but if you kind of fall into one of these brackets, you may end up finding that you're paying a higher premium. Typically, when you fall into IRMA, you're subject to IRMA for a 2-year window. And so just kind of keep an eye kind of on those numbers. All right, let's talk about prescription drug plans. And so I think for many of you on the phone, you may realize that Parts A and Part B don't cover the totality of what your healthcare costs are. And so, a large proportion of Americans today are enrolling in a Part D prescription drug plan. So today it's over 80% of Medicare enrollees have this Part D plan. The premium actually dropped slightly in 2024. It went from $56.49 on average to $55.50. And so you might see a modest decrease in your prescription drug plan. The key thing here, again, is making sure that you've allocated for, the drugs that are actually covered in the plan. And I think the big, probably surprise factor we find from a lot of retirees is, that realization that some of the drugs that they may need at some point during their retirement may not actually be covered by a plan. All right, so Medicare Advantage. So, once you've enrolled in Part A and Part B, one of the big decisions you have to make is whether you want to go what I would call like the a la carte route, which would be what's called a Medicare supplement plan, where you're saying I'm buying additional insurance, or you go the Medicare Advantage route, which is more of a bundled premium. And so when you think about the Medicare Advantage plans, what we're looking at here is factoring in, a couple different components. So the first thing is your Part B premiums. The second piece is that you're going to have a deductible, and then there will be an average premium for Medicare Advantage. Those premiums are up about 3.5% year over year. Again, one of the things I would just flag is that oftentimes Medicare Advantage is quoted as kind of a low cost opportunity or a low cost plan. Particularly, many of these plans will offer like closed networks, and those plans, again, when you're hearing those television advertisements, I would just say to you that they're quoting premiums. They're often not quoting total cost. And so when you think about budgeting for total cost, I would just advise you to really be thinking about that $500 to $600 per month basis when you're thinking about really needing, to get extra coverage from your healthcare plan. And then finally, on the Medicare supplement plan, the Medicare supplement plans on average have increased 2% in 2024. So they're running about $183 per month versus the last year the plan's running about $180 a month. Again, each of the plans can be different. There are multiple different types of plans. So these plans that we're quoting here are Plan G, which is the most popular type of plan. But depending on what sort of coverage you're looking for, deductibles, provider networks, and if you want out-of-country coverage, you can see that price vary. Again, these prices are based on the average, where you live is going to impact what that price is. All right, so let's take a look at the total costs for Medicare supplement, and then we'll take a look at the total cost for Medicare Advantage. So for Medicare supplement, when you think about the full bundle, you're going to buy Part A and Part B. You're going to be subject to the Part B deductible. You'll likely buy a Part D prescription drug plan. And then you have the supplemental plan plus, additional out-of-pocket expenses. And so that is how, when you think about like adding up all the numbers, that is how with like a supplemental plan in 2024, you can see, an average price of about $560 per month. On the Medicare Advantage side, I would just say that some of the numbers, haven't been fully released yet. And so what I would just say is that the numbers have gone up year over year, but what we're still waiting for are those final numbers to come out from the government on the average in-network out-of-pocket limits, which is really what you have to focus on with Medicare Advantage. There are going to be out-of-pocket costs that are not part of the premium. And understanding when you choose a plan, what the out-of-pocket limit is going to be very important to really thinking about, what your cost of a Medicare Advantage plan is going to be. The other thing to keep in mind is that, where costs can get particularly punitive with Medicare Advantage is when you go out of network. So what I've quoted here is the in-network out-of-pocket limit. The average last year was about $400, and we're waiting for that new number for this year. If you look at the out-of-network limits, those numbers are often double the amount. And so this is where, as you're choosing your Medicare plan, really making sure that the doctors you want to be able to see are in-network is going to be an important factor for Medicare Advantage. If you think you'll be going out of pocket or out of network a lot, that's where oftentimes looking at a supplemental plan may be a more preferential path for you. All right, so I've mentioned this before, but I just want to kind of say it again, which is, these costs vary based on where you live. Again, so Part A and Part B priced federally, and those numbers are the same no matter where you live. But Part D, Medigap, and are priced based on your zip code. When you create your profile at Retirement Simplified, one of the easy things that you can do is type in your zip code, and you can actually get an estimate of what your healthcare costs will be. We're in the process right now of updating those numbers for 2024. So right now you'll see the 2023 numbers. And in the next couple of weeks, we'll be loading up the data so that you can see the 2024 numbers in there also. All right, let's talk about ACA planning. So I imagine that some of you on the phone may not be 65 yet, and maybe you're hoping to retire before you turn 65. And one of the big things that you really have to think about is, what your healthcare options are when you retire before you're eligible for Medicare. It may be that you have a spouse, and so you'll be able to be on your spouse's plan. It may be that you have COBRA, and so you use COBRA to bridge you to Medicare. But if you don't have those options, you may find yourself looking at the ACA market. I think one of the things that when I speak to soon-to-be retirees really surprises them about the ACA market is that it's one of the few parts of the healthcare market where plan prices are based on your age. So, for example, you may have helped an adult child in their 20s with healthcare for a period of time, and you might have been helping them pay a premium of, let's call it $200 to $250 a month. But the ACA price, the premiums are demonstrably higher when you're in your 60s. And so in 2024, the average ACA plan for an American over the age of 60 is just over $1,200 a month, which is a lot. The one thing I would just flag is that 2/3 of consumers actually don't pay the rack rate for ACA. So 2/3 of consumers are paying less than $10 a month for their ACA plans. And that's because there is a subsidy for ACA. And so if your income is below certain thresholds, you may be able to get a subsidized access to COBRA. So what I'm showing you here is like the full price. But again, 2/3 of Americans are actually qualifying for a lower premium as a result of having lower income. One thing just to flag is that often folks, when they look at their initial COBRA premium, they think to themselves, well, that seems high because they were perhaps, they were paying a little bit of their healthcare when they were employed and their employer was paying most of it. And when you go to COBRA, you pay the full amount. You might find that if you don't qualify for a subsidy, that your COBRA payment is actually less than ACA. So we just encourage you that as you start looking at, your enrollment options for the upcoming year, that you really just kind of think through what those options are. And if you think that ACA is the right path for you, I would just go check and see whether or not you qualify for the income subsidy. All right, Social Security. I'm going to take a little bit of a step backwards and just talk a little bit about why Social Security is important, and just because it's something that's near and dear to my heart. We see a lot of data at Retirement Simplified, and what we know is that for most members, that Social Security is their largest retirement asset, and that's because when you add up, a benefit of $2,500 a month, for example, it adds up to over $600,000 over the course of your retirement. So Social Security is not a throwaway government benefit. It's something you've earned. You've paid a lot of taxes into the system. And what we want to make sure is that you're getting your fair benefit as you prepare to retire. So a couple things just to be mindful of as we think about Social Security, and then we'll talk about the updates the government made. So the first thing is that in order to qualify for Social Security, you need to work for 40 quarters or 10 years. For some reason, government likes to talk about it in quarters, even though we humans typically think in years rather than quarters. It doesn't need to be consecutive. So you could have worked for a couple of years, taken some time off, and then worked again. As long as you cumulatively have worked for 40 quarters, you are eligible for Social Security. One of the things that a lot of folks try to think about is like, when do they elect Social Security? That's because you can elect Social Security between the ages of 62 and 70. Today, the full benefit is available to you at what's called your full retirement age, which is age 67. If you take your benefits early, the benefits are reduced. If you delay your benefits, you can actually increase your benefits by 8% per year up until age 70. So I think one of the biggest decisions folks will make is when they elect Social Security. I think one of the things we think a lot about here at Silver is that this may be one of your only sources of longevity insurance in your portfolio. Whether you live to 80, 90, or 100, that Social Security will be there. And so would really, as you make your election decisions, I often think about this as like my hedge in my portfolio, that if I live a long time, it's that one source of income, if I don't have a pension or an annuity, that will really be there to provide for me later in life. Again, I talked about this, when you can elect Social Security. So you can elect between the age of 62 and 70. Full retirement age is 67. The maximum benefit can be earned at age 70, and you can elect as early as 62. There are some special rules if you are widowed, for example, where you're able to access Social Security earlier. But this is when I think about kind of just general retirement benefits. This is when most folks are eligible to elect. All right, so I talked about longevity insurance. One of the things that's really amazing about Social Security is that it has a built-in cost of living adjustment. What that means is that every year, Social Security either keeps your benefits flat or steady, or they increase it. They never reduce the number. They always either keep it flat or they increase it. Many of you may have remembered that the number was really high last year. So in 2023, so the calendar year before, Social Security benefits were increased by 8.7%. So a really large number. And that's because we were coming off this, really high inflation period. It was the largest largest cost of living adjustment in 40 years. So this was kind of pretty significant when you think about kind of the context. The cost of living update this year is 3.2%. And so it's still an increase. I know everyone is feeling it in their pocketbook. Gas prices still high, groceries still high. If you're renting, you're probably still seeing rental increases. What I would just say here is that the number isn't as big as it was in the prior year, but remember that you get your benefit last year, and then it's this 3.2% is added on top of it. So you're cumulatively talking about an 11 to 12% increase in your benefits over the last 2 years. If you haven't elected Social Security, that's also actually built in. And so your benefit is growing, just like folks that are receiving Social Security. The other thing I would just say is that, as I mentioned to start with, is that the cost of living adjustment is announced every single year. The number is always positive. For those of you that are receiving Social Security right now, you will be receiving a statement from Social Security in the next week or two that will actually tell you what your new benefit's going to be. And that new benefit will start to hit, hopefully, your InTouch Credit Union account in January of 2024. If it's not going to InTouch Credit Union, I'm sure that Rufus can maybe pass along the direct deposit details at the end, just to make sure that you can get your Social Security into InTouch. So the first paycheck will hit in January. Again, you'll get the announcement in December. The other thing that's in the announcement that comes from Social Security is actually your Medicare costs, because what the government does is they deduct your Part A and Part B premiums from your Social Security. And so you receive a net payment from the government, which is Social Security minus your Medicare costs. And this is where, if you're subject to IRMA, this is where you'll see on this statement from the government in December, you'll see that they are charging you with the IRMA surcharge if they think that you're a high income earner. If you don't think that you were a high income earner, there is actually a way to go back to Social Security and say, look, I'm being charged this extra premium that I shouldn't be subject to. If that happens, feel free to email Rufus or myself, and we'll actually walk you through the process, because there's some simple paperwork you can fill out there to help you basically tell the government that their tax numbers aren't correct. But again, like, I think the main thing here is you're going to get this adjustment. It'll hit in January, and you can check your numbers in December and make sure that they look right to you. For those of you that are still working, one of the ways that the government is able to pay these cost of living adjustments is that they also increase the amount of employees' income that's taxable. So in 2023, if you earned more than $160,000 per year, the first $160,000 was subject to Social Security tax, which is 7.65%. And then, your employer puts in another 7.65%. But if you earned above $160,000, the additional amount wasn't subject to Social Security tax. In 2024, that cap has been increased from $160,000 to just under $169,000. So that cap has increased by 5.2%. So that's, unfortunately, for those of you that are in those ranges, it means that you are going to be paying more taxes. And that is really how the government is funding these cost of living adjustments for retirees, is by every year increasing the amount of your working paycheck that is actually subject to the Social Security tax. One other thing I would just flag is that we see a lot of soon-to-be retirees thinking about working part-time. And so oftentimes they'll say, well, look, I think I want to retire from my job at 62, 63, but then I'm going to work part-time, and it might be work part-time so I can get healthcare benefits. That's one of the kind of the top reasons we hear folks who are retiring before 65 thinking about part-time jobs. The one thing I would just flag for you is that if you retire before the age of 67 and you are working part-time and you've elected Social Security, you need to know that the government puts a cap on how much you can earn as part-time income before they withhold some of your Social Security. The withholding is actually a deferral, so it's not the government is fully taking it away from you, but they do say that if you earn more than, for example, in 2024, you earn more than about $22,000 and you're under full retirement age. So let's say you're 65 years old and you have more than $22,000 of part-time income, they will not pay out your full Social Security benefit. They will then give you that money back once you hit full retirement age. This is, I would just say, honestly, like a pretty convoluted rule. It's kind of emblematic of the fact that Social Security was built in the 1920s and 1930s when the world looked differently. A lot of retirees are working part-time today. And so it's actually a part of the Social Security code that I'm really hopeful will be reformed. But in the meantime, as you're doing your budgeting and you're thinking about how much you could get from Social Security and how much from part-time income, I do want to just flag that income cap. Now here, income is really defined as W-2 income. So this is different than what I talked about with IRMA, where like selling a house was treated as income, or rolling over an IRA could be treated, or converting an IRA could be treated as income. This is just traditional earned income that is captured by this part-time earnings cap. All right, so we've covered Medicare, covered ACA, Social Security. Let's move on to retirement savings accounts. So for those of you that are still working, you are able to now contribute a little bit more to your 401ks. So in 2024, the contribution limit will be $23,000. If you are over the age of 50, which I would imagine most people on the phone today are, you also have the ability to do what's called a catch-up contribution. That number has actually not changed year over year, but in total, you'll be able to put a little bit over $30,000 into 401ks if you're above the age of 50. So that's kind of number one, and again, this is part of these inflation adjustments. The government is saying, look, we understand inflation is high. We want to make sure that you can, if you have the ability to save a little bit more, that we're also thinking about like inflation adjusted limits. On IRAs, we also saw an increase announced by the IRS. So for IRAs, and that's also for Roths, you can put $7,000 in those accounts in 2024. For those of you that are above the age of 50, you can also put in an additional $1,000 in catch-up contributions. So that in total for the members that are on the phone today is about $8,000 a year that you're able to put in those IRA Roth accounts. Many of you may be aware that Roth IRAs are subject to income caps. And so basically the short story here is that the government says that a Roth IRA is available to folks who have earnings below a certain amount. And if you if you go above those thresholds, then you are no longer eligible to put money in a Roth. And so today the income phase out for Roth IRAs, if you're single, you phase out at $161,000. There's like a graduated phase out, but the top level of the phase out is $161,000. And if you're married, filing jointly, the top level of the phase out is $240,000. There's obviously a couple other tax filing statuses like head of household and whatnot. And if those numbers apply to you, all those details are in our class in Retirement Simplified. So you can kind of pull back up that table and take a look at it for yourself. Those caps increased in 2024. They increased just under 6%. So what the government is saying is we're going to allow, a few more people to put money in Roths because we want to just kind of adjust kind of the income caps because we know that inflation has been high. All right, let's end on taxes. So the first thing to know is that every year the government changes the tax brackets. And that's the IRS. So the IRS every year has the authority to announce updated tax brackets. And they're really, the guidance that they have from Congress is that they can update these tax brackets based on inflation. The rates themselves have not changed. So the rates have to actually be, put through Congress. And so if there are rate changes, Congress actually has to approve the rate changes. So what the government is doing here is they're basically similar to what we've seen in some of these other concepts is the government is saying, I'm going to adjust higher these brackets so that folks can earn more at lower tax rates. So that, again, we're accounting for inflation. And so, just an example here would be the 22% tax bracket in 2023 ended at about $95,000 worth of income. And today it ends at about $100,000 of income if you're single. If you're married, those brackets are higher. So again, for the federal tax brackets in 2023, that top level of 22% was $190,000. And for 2024, the top level is a little bit over $201,000. So your accountant, when you file your taxes, like this will all flow into their tax calculations. But for those of you that are, are running spreadsheets on the side or want to really understand, what your tax bracket looks like, I would just guide you that the brackets do change every year. One of the things that we do every year in Retirement Simplified is we actually update all of our numbers to make sure that what you're seeing in the experience reflects the latest tax year. And so we know that it's important that, your numbers are up to date. And so we include that information in the experience. The other thing that happens in addition to the tax brackets being updated for inflation is that the standard deduction is also adjusted for inflation. And so this year, married couples filing jointly had about a $1,500 increase in their deduction to just under $30,000. Single taxpayers saw their deduction increase to about $14,600, which is about a $750 increase. And if you file as head of household, you also saw an increase. So, I would say generally these numbers are to your benefit, right? The government is saying, look, we understand that inflation is high. Many of you may have, as a result of that, had like an inflation adjustment to your salary, and they want to make sure that you're able to take home kind of equal pay and not have more of it taxed just because you had an inflation adjustment with your salary. Wrapping up taxes, the other thing I would just say is that, every year the estate tax and the gift tax numbers also increase. And again, these are just with inflation adjustments. This is what the IRS is allowed to do and is built into the kind of the tax code. Major changes, particularly when it comes to the estate tax, are really governed by Congress. And so any of the changes that we've seen are really just the inflation adjustments. So the one that's probably relevant for most people on the phone today is the gift tax. And I thought I would just highlight here that for the gift tax threshold, it increased in 2024. So for 2023, the gift tax exemption was $17,000. The gift tax exemption has now increased to $18,000. If you are married, you are able to give 2 times the gift tax to an individual. And so, and again, this gift tax exemption is on a per person basis. and per recipient. And so if you have 3 kids, you could give each of the 3 kids $18,000. If you're married, you have the ability to do double that. And so again, just want to flag that those numbers have increased as a result of these annual updates that the government has put in place. All right, final one I just want to flag is health savings accounts. So health savings accounts, I would say, are like the secret, one of the least used but most valuable retirement benefits. If you have a high deductible healthcare plan right now, you are able to put money away in a health savings account. And if you can put that money away and hold on to it for retirement, it can be extraordinarily powerful. HSAs come with what's called a triple tax advantage. You can contribute pre-tax money to the accounts. The accounts can grow tax-free. And then in retirement, you can also withdraw the money tax-free. So that is the only account. When you think about a Roth, you put money in post-tax, but then has this tax-free growth and tax-free withdrawal. What's super unique about an HSA is you both contribute pre-tax and you take money out pre-tax if you wait until you're retired. And so the amount that you can put in those HSAs in 2024, if you're single, it's $4,150. If you're a family, you can put up to $8,300 in those HSA accounts. So that's just one other thing to be thinking about. If you have extra cash, to be thinking about what type of account would you put it in. If you don't have an HSA, that's something that I would highly recommend taking a look at. All right, so I know we covered a lot of numbers, and as I said in the beginning, we're going to, like, all of these numbers are in our retirement school class. Also, when you create your profile at Retirement Simplified, we create a profile for you and we pull these numbers in automatically so that you don't have to keep track of them. And so just knowing what your zip code is and knowing what your age is, we're able to estimate, what your Social Security should look like, what your Medicare costs will be. And so we do a lot of that number crunching for you. But we know a lot of folks, are really interested in what's happening year to year. And so we wanted to share these numbers with you. So if I just kind of think about like summarizing what we went through today, the first is kind of the bad news is that healthcare costs generally increased, depending on which premium we're talking about. Some of them increased more than the cost of living adjustment for Social Security, and some of them were a little bit less. ACA premiums were also on the rise. And I think the big thing I would just encourage anyone who's thinking about retiring early to look at is to really take a look at those age 60 plus premiums, determine whether or not you qualify for an income subsidy. And if not, take a look at that trade-off between a COBRA plan and an ACA plan. Social Security, if you're receiving it right now, you will start receiving a 3.2% COLA adjustment. And again, Rufus is here to help with direct deposit into InTouch Credit Union. You'll get documentation from Social Security this month, which will tell you what your new benefit is. You can also log into your online account to get that information. On the retirement savings accounts, we walked through the inflation adjustments. Like, the goal here is to help you save more if you have that ability. Obviously, I recognize that in a world that we're seeing high inflation, we may not have more money to save, but just to be mindful, the government is putting those options out there. And then finally, on the tax side, we did see inflation adjustments to the tax brackets as well as to deductions, again, giving you that ability to go to higher tax brackets or to higher income levels before you pay higher taxes. So that's a lot of information to cover in 40 minutes. So I thought what we would just do is we're going to open up the chat line and answer questions. And I know we have a couple already that came in before. So I thought maybe, Rufus, I would start with those. And then we can see what other questions folks have that we can answer as we go through this. So the first question we actually have kind of just talked about, which is, when am I going to receive that Social Security update? And again, it'll start hitting your bank account in January 2024, and you'll get that benefit over the next, or you get that benefit statement over the next couple of weeks from Social Security. Second question that came in early was around how can I calculate my Medicare costs, and this is where I think if you create your profile at Retirement Simplified, we can get you started. We can help you put together kind of the package, understand Part A and Part B, see what a prescription drug plan would cost, as well as a supplemental plan. And then you also, if you're thinking about moving, and whether you're moving full-time or you're thinking about moving part-time, the important thing with Medicare to know is that where you're a tax resident is where you enroll in Medicare. So for example, if you are a snowbird in Michigan and you spend part of the year in Michigan and you spend part of the year in Florida, the place that you enroll in Medicare is going to be the state that you're resident. And so really understanding like how that kind of impacts your healthcare cost is going to be important. But again, you can type your zip code into the experience and we will calculate those numbers for you and kind of put those numbers into your full retirement score for you. All right. Are there any other questions on the line?
So there's a question. It said, you said that Medicare can be used internationally.
Yes, good question. So historically, certain supplemental plans were available for use internationally. So for example, if you're traveling, you're on a cruise or whatever you might be doing, you can use your supplemental plan. Historically, that was not an option that you had with Medicare Advantage. I say historically because it was probably one of the big benefits of a supplemental plan that folks who are on Medicare Advantage really missed. And so you're starting to see some Medicare Advantage plans offering overseas coverage. If you are looking at traveling, and I'd say more than just, going on a vacation, I would, quick vacations, when you are enrolling in Medicare, I would ask the questions to make sure that you understand like what is and isn't covered under the plan, because each plan is going to be specific about what's being offered. And sorry, that's not like a clean yes or no answer, but this is where the devil's in the detail with Medicare. And so I would just say is if you plan to travel and spend significant time abroad, you need to make sure that when you're enrolling in Medicare, that the plan that you're enrolling in, and it's really you're checking to see, does Medicare, is it Medicare Advantage or supplemental plan? Do they have overseas coverage? Your Part B will cover you for some of the basic hospital stays, but what you really need is that kind of broader coverage. You need to know whether you have that while you're overseas. All right, so I see Silver has a website. Is this a separate service or can we access it through ITCU? So this is an exclusive partnership that we have with credit unions. And so Silver, our company, has this retirement platform that we only offer to credit union members. And so if you go to itcu.silver.com, you'll find that free benefit there. So no cost to members. ITCU buys this on behalf of members so that you can get this retirement education. Rufus, why don't I let you get to the next one?
Sorry, my thing went muted. There we go. Can you move to lower cost country and use Medicare, or that is only for occasional travel?
So, look, I would just say here, and if you don't mind maybe sending Rufus your email address, we can triple check this for you. But my understanding of Medicare is that it's really intended for folks that are resident in the US or Puerto Rico. So if you're planning on truly moving abroad and you're no longer kind of a tax resident here, I don't believe that you can get the full Medicare coverage. I want to just do a little bit more homework there for you, because that's, I would just say, a kind of a fact pattern that I'm not 100% certain on. And so I will do that research. But if you can just drop into maybe the anonymous chat, your email address, Rufus and I will follow up with you.
Okay. So questions are coming in. Here we go.
Okay, we've got your email address, so thank you.
Are federal taxes automatically withheld from Social Security payments?
Yeah, that's a really good question. And the answer is no, which I think is often a big shock for retirees, because you're kind of used to, when you've had W-2 income, that the first paycheck you get, just already the taxes are being taken out. So you do need to opt in to withholding for taxes for Social Security. So if you don't opt in, what ends up happening is that you get put into this concept called estimated tax payments. And for those of you that pay estimated tax payments, what you know is that every quarter you need to basically make an estimated tax payment to the government. People have different preferences. My own father, he's 72. He does the estimated tax payments. He doesn't mind doing that. He likes to hold on to the cash for an extra month or two. And so for him, the hassle factor of doing the quarterly estimates is worth the fact that now that you can earn more in your In Touch credit union account, he is happy to hold on to the cash for an extra month or two. But you do need to make that decision to withhold if you want to kind of make it as simple as it was when you were working. All right, Rufus, we have another question, I see.
Yep. I'm assuming that's why are we taxed on Social Security? We already paid this from our taxed money.
I hear you. So this is, what I would just say is this is a comment I hear from a lot of folks who are quite frustrated to hear that the government savings program that they've been taxed and paid into, that it is taxed again when they retire. It is just the way the rules work. I'm not saying in any way that it's fair, but it is the reality is now not all of it is taxed. And so in our retirement school classes, we actually show you how much is taxed because depending on how much you're receiving, there's different amounts that are taxed. The other thing to think about is depending on what state you live in, your state may or may not tax your Social Security. So there are about 11 states that tax Social Security. So it's actually not only federal taxes that you need to be prepared for, but you need to take a look at state taxes. We have a whole set of classes on state taxes on retirement income, so that you can basically take a look at your state and understand what additional taxes you might be charged with as you retire.
Right now, there are no other questions. Does anyone have any other questions before we wrap up for our webinar today?
So Rufus, well, why don't I just make one or two last comments, and if someone comes in at the last minute with a question, we can certainly answer it again. I've referenced a couple things about other things that you can learn. So here's actually a whole bunch of classes that are kind of tax related that as we start thinking about annual updates and things that may be impactful for you that you can kind of see. So we have a lot of classes on taxes, a lot of classes on Social Security, understanding how to elect, when to elect, how spousal benefits work. And so all of that is included in the platform. And again, the easy way to do it is if you're on your computer today and you've got a phone next to you, you can just scan the QR code. And then we also have through the website itcu.silver.com. I see one other question, Gerald, and it's just how does starting disability before full retirement impact Social Security at full retirement age? I want to triple check this, but my understanding has always been that if you elect disability, that the disability benefit then becomes your retirement benefit. So it's effectively that you've locked, like let's say you opt into disability or elect disability at age 55, that the government then says that you have elected it early, and that is going to be the benefit that you'll receive in retirement. I'll do one or two little checks there. So Gerald, if you don't mind just dropping again your email address into the chat, into the anonymous or into the confidential chat, we will just get you a little bit more information. But generally, disability means that you're basically triggering your retirement benefit early. And so, there is no concept of getting extra benefits for delaying. And then Rufus, I'm going to have you, if you don't mind, into the public one, if you can put your email address so folks have that too, if they want to do follow up.
Yep, I can do that. And then it looks like we've got a couple more questions that have popped up. So can you opt out of Medicare if you are over 65 but still have an employer's medical coverage?
Yeah. So that's a really good question. And as in many things in life with the government, the short answer is it depends. Maybe I'll give you a little bit of information, which is the government wants to make sure that when folks are 65 that they're enrolling in Medicare. They don't want this to be perceived as an optional plan, like it's a mandatory program. And the reason they don't want it to be optional is that if folks start opting in and start not opting in, then there's more risk for the government for the folks that haven't kind of opted into healthcare. That being said, there are certain scenarios where you are still working and your employer plan can cover you. And what happens in those scenarios is that you are given a short window after you retire and you no longer are employed to then enroll in Medicare. If you don't enroll in that special enrollment period, you will be subject to lifelong penalties. And so it's not like there's a one-time penalty. They actually penalize you for the rest of your life. And so the thing that I would just say there is that it's super important to check with your employer. If you are 65 and still working, or you're about to turn 65, you need to check with your employer. Make sure that their plan allows you for you to stay enrolled in Medicare. Typically, you will still enroll in Part A, but oftentimes you'll have the ability to defer Part B and the other programs, provided that you then enroll during what's called the special enrollment period, which is typically a 3 to 6 month window after you retire. But again, the penalty for getting it wrong is really high. And so that's why I would just double tap and say, do talk to your employer, because their benefits team should be able to confirm for you that you are able to defer with the plan that you're in. All right. Well, I would just, I mean, and I know, Rufus, you're going to wrap up, but I just want to say great questions. One of the things that I'm very passionate about is making sure that members like yourselves are getting the most out of your retirement. And I think, I would say, without knowing all of you on the phone today, my guess is that you are law-abiding, tax-paying citizens who've been working really hard for your retirement. And the government doesn't make this easy. That's why we built Silver, was try to make it easier for Americans like you to navigate retirement. And we're thrilled to partner with InTouch Credit Union to make this a member benefit, so that together we can really help you live your best retirement. But Rufus, with that, I'll pass it back to you.
Yeah. Well, we appreciate everyone's questions today. Hope this was very informative for the start of your 2024 tax year, if you will. Rian, as always, we appreciate you being here, including your team. We look forward to next year's seminars as well. We are looking at continuing this process as long as we have great feedback from our members that this is impactful and meaningful information for the retirement and any other updates that come out throughout the year. So be on the lookout for those starting in January, and hope everyone has happy holidays, and we appreciate you being here. Thank you so much. This is our last webinar in the series until the beginning of next year, and everyone be safe. Thank you.
Thank you, Rufus. Thank you. Bye-bye.